Welcome to this weekly update. I'm Julia Lee, an equity strategist with Bell Direct. And after 6 consecutive weeks of gains, the Australian share market has finally given up, down by 0.5% for the week, as the rest of the big banks trade ex-dividend. But having a look around the market, and let's start off with Value Host and an equity strategy view on the Aussie market. First of all, in the US, we've seen S&P 500 quarterly earnings booming, rising 25.6%. And while the Trump tax cut has directly contributed, it's contributed about 7.5% of this growth. And that means underlying earnings is still up an impressive 18.1% year on year. And that's on the back of strong top-line growth, rising margins, as well as strong buybacks. Nevertheless, if we have a look at the US stock market, it's roughly flat year to date. And in Value Holster's view, there's 3 headwinds that are holding back the market. There's still the threat of protectionism, geopolitical uncertainty, and also rising bond yields, which we have seen being a key feature of the market this week. As such, they expect an earnings-led global equity rally led by the US in the second half of the year. And this reinforces their view for growth assets and recommend overweight positions in international equities. Their preferred stocks in a balanced portfolio for Aussie-listed stocks include Macquarie Group, Janus Henderson, Magellan Financial Group, Lendlease, Brambles, Amcor, as well as James Hardie, and to a lesser extent, ResMed, Sonic Healthcare, and Nufarm. Moving on to Morgan Stanley, which is looking at the healthcare sector and the latest Medicare numbers, which point to strength in diagnostic imaging but weakness in pathology. They do prefer Sonic Healthcare to primary, and that's due to the greater risk for primary healthcare given there's no quick fixes for its medical centers. It also likes Sonic Healthcare, ResMed, and Cell, all trading overweight, but it's underweight primary healthcare. Having a look at Morgan Stanley and energy has done well this week. In fact, the Morgan Stanley team raising its oil forecast to $90 a barrel by 2020. Given that view, it's overweight Woodside Petroleum, Beach Petroleum, FAR, and Worley Parsons. Looking at odds, which is also looking at energy and the current spot Brent price, which is up 20% since the beginning of the year. In fact, if you valued some of these energy companies at spot, there would be significant upside. And at spot prices, Beach Petroleum and Oil Search would have the greatest upside, followed by Cenex as well as Woodside Petroleum. At forward prices, once again, it's Beach Petroleum and Oil Search with the greatest upside there. So energy doing well on the market, and analysts expecting it to continue to do well in 2018 and beyond. Looking at a technical view now from Morgans, where it sees computers share in a strong uptrend which remains firmly intact. It says that any weakness is a great opportunity to buy in. Its target price for computer share is at $19.90 on a technical view, and it also likes IMF Bantham. It has an initial target of $3.15 based on its breakout, and FlexiGroup FXL saying that the decline has lost momentum here. The price has been forming a base, and it sees upside potential with a target price of $2.45. Looking at Macquarie, and here we move on to the Australian iron ore miners and the latest iron ore shipments from the key ports in Western Australia. Now, we have seen shipments increasing significantly in recent weeks, although that might not be enough for BHP and Fortescue to hit their FY18 shipment guidance. Now, record quarter is still expected for the June quarter, but it looks like BHP could miss their shipment guidance despite their recent downgrade. Rio Tinto, though, looks on track to deliver a solid result in 2018, and there's still upside risk as spot prices remaining for BHP and Rio Tinto, and that means they remain positive on iron ore equities. Macquarie does prefer BHP over Rio Tinto and also has an outperform rating on Fortescue as well as Mount Gibson. Looking at Credit Suisse and the insurers, we did see premium rate increases in June 2017, but Credit Suisse saying that expected churn means that it's hard for the insurers to pass this on. They continue to prefer the domestic names of Insurance Australia Group and Suncorp Metway over QB Insurance, but they currently have a neutral on all three names. Increased confidence around the ability to achieve ongoing premium rate increases would lead Credit Suisse to take a more positive view on these insurance stocks. And it's quite unusual for brokers to put out sell ratings, but there's certainly been plenty of them this week, so just highlighting a few of them. And Citi has had a sell on Treasury Wine Estates, saying that the pace of growth does not justify the price to earnings ratio. The company has been mostly reliant on margin expansion with very little organic volume or pricing growth. It also has a sell on Dulux, saying that growth is too slow as cyclical headwinds build. And it has a sell on Myer as well, saying that the risk reward is unfavorable. There's no visibility on the new strategic direction as yet, and relief from covenants are a constraint on spending on investment in the near term. They maintain a sell on Myer with a 41-cent target. Also looking at Bell Potter, which has a sell on Elders, saying that underlying seasonal and commodity drivers have weakened. There's no formal guidance from Elders on what they expect, but the key drivers are sustainability of the value of their livestock turnover, their ability of management to execute on their capital light strategy, and near-term winter cropping, which at this point is looking below average. So all in all, plenty to focus on, but overall, just looking for that earnings growth from the US to help support global markets till the end of the year. I'm Julia Lee, an equity strategist at Bell Direct. Hope to see you next week.